Oh, nice. Thanks, Keaton. And I know that I've really enjoyed the webinar series so far. So I really appreciate you putting all the work and time into making it happen. It's pretty awesome to get all this information and not have to pay for it or, shell out money to join a course and figure out which areas we maybe already know information and which areas we need to learn some more in. And so that's been really great. Really appreciate it. I really enjoyed Chris's webinar last week. So thanks.
I always enjoy the tax one. It's
I
always, you never know what you're going to get.
I love the tax one.
But I think we're in the industry when you get excited about taxes.
Financial planning and the Smith Manoeuvre, a bit about my background and how I started. I've been in the financial advice space for just coming up on 15 years now. Been through a few different market cycles and different companies. When I first started, I worked for insurance companies and for banks. And I thought I'd be giving financial advice. And it turns out at the banks, I was just selling mutual funds. And so, to start, it was great. First couple of years of my career, learning at the bank, everything was new and everything was exciting. I didn't know anything and it was great. But I quickly realized that if I wanted to give financial advice, I would have to start my own company. That was, the clear trajectory. So in 2015, my wife and I started a company called Mula Financial Coaches and Advisors. In 2018, I became a financial planner. And then I've been a Smith Manoeuvre certified professional for, 18 months or 2 years now, however long Robinson started that. And I would say the last 5 years of my career just really focused on planning and financial strategies, teaching financial strategies. Really at the core of our practice is having people achieve the goals that they want to achieve and really get some joy back into their money, because I feel like a lot of us, when it's boring or when there's not really much to talk about, the joy can really get sucked out of that. So, and it's been a great little journey with my wife as well. My wife, Lindsay, she actually works more on the practical side of money. So she deals with budgeting and she has a lot of video courses online that she offers. It's been a nice little pairing over the last 5 or 7 years now where she handles that and I do more of the planning. So that's where I would start off. A little bit about myself, and then I can roll right into this now if you want.
Sure. I'm excited to see it.
All right.
I've heard clients rave about what you do, so I'm excited to see it.
Sure. So what is financial planning? And I think this is really a part of what sucked in this industry is that we go see a investment advisor or a financial advisor or somebody at a bank or what have you, and financial planning gets lumped into that when really it's just selling a product. Insurance industry, they're trying to sell a product way ahead of the planning. And so when it comes to financial planning, what is it? What are the pitfalls? I wanted to explain that a little bit here. So financial pitfalls, when it comes to financial planning, the first one is we're all busy. And I was telling Keaton, I hired a business coach this year because I felt like I was being pulled in all directions and I didn't have a great focus going on. I didn't have a plan in my business life. I was just doing whatever it was. And I think that happens to all of us. We get to that stage where we're trying to balance work and life. And should I spend some money on my lifestyle now? Or, should I be saving hardcore, or can I spend a bit of money to increase my lifestyle, make sure I'm having, joy in my life and I'm having fun in my life? And that's a lot of my financial planning advice is people like, should I do this or should I do that? And I say, well, mathematically, it's about the same. So whichever one brings you more joy, I think that's the one that you should do. Many of us are not content purchasing investments without adequate research. This is so important to making an investment decision. First of all, investigating the investment, doing the research, what are the financials behind it? But then does it also fulfill a goal of mine? So we're just kind of buying investments because we see a presentation and it looks good. Not a lot of us have somebody that we can book a meeting with and go and investigate a product together. And that's a role. Constantly wondering if we're doing the right thing. So losing sleep at night, just arguments with our spouse, not sure if this is the right investment, and then we're caught in a wondering cycle. We're not able to make a purchase, we miss it, that sort of thing. And then making decisions randomly on siloed information. A whole life dividend paying participating policies, probably not the first investment that you should purchase, like 9 times out of 10, probably not. But if you go and see a presentation and you listen to one person talk, it can sound really, really good. And so sometimes we make a decision like that in a siloed environment instead of taking a look at multiple aspects or multiple parts of a plan. So what is financial planning? I think one of the most important parts of financial planning is planting a flag in the ground that we can now measure all of our decisions against. And this really helps, in my opinion, align things long term and simplify the decision-making process. If I have something, a decision that I've made, an agreement that I've made, a flag in the ground, and I can say, oh, does this real estate investment align with that? Is it A, B, and C, the 3 things I've decided? Yes, it aligns, great. I can go pursue that. But maybe it's not as green as I want it to be. Maybe it's the house is older than one of my criteria because of maintenance reasons. I never buy a property that was built before 1980. Well, if that falls outside of the decision making, maybe that's an easy way to make a decision. So establishing a flag in the ground is a great beginning point. Financial planning is creating a plan on what you're going to do with your money in order to create financial security, wealth, and asset growth in the future. So we are telling our money what to do. The last thing we want is for our money to randomly be spent in different places and us not have a plan on how much money per month or per year or over the course of the next 10 years we're going to be investing long term. And then the third point I have down here is don't miss a step. So quite often when we're doing financial planning on our own, and maybe our financial plan is I'm just going to keep buying assets, as many real estate assets or publicly traded security assets or whatever it is you enjoy. But we haven't gone through a step-by-step process and ticked all the points. And working through a financial plan allows you to go through step-by-step of all the different areas to work on. And some areas are more important to you than others. And so you can kind of skip over those or not spend as much time on them. But once you've gone through a financial plan, you don't have to wonder anymore. There'll be a whole bunch of things you never even thought of, things you didn't know that you didn't know. And now they're in there, they're in your wisdom silo. You know enough about them that you either care about them or you don't, and you can move forward. And so we really want to help people with research and then create action steps to move forward. When it comes to the Smith Maneuver, because this is focused a little bit on the Smith Maneuver, these webinars have been. Most of you who have read the book or been around the Smith Maneuver know that the top benefits of the Smith Maneuver, the first one is having equity in your home invested to increase your net worth over time. And what that's invested in can be a broad range of things. The second one is when we borrow to invest in Canada, the interest we pay on that loan is tax deductible, and we can use that money in a plain Jane Smith Maneuver to prepay our mortgage and pay it and convert quicker. And so those are really the 2 basic levers that we're using in a Smith Maneuver as it was, sort of originally created. The benefits of working with me and any of the Smith Maneuver certified professionals in my area is you get the correct implementation of the Smith Maneuver. So most clients, after working for about an hour together, they experience confidence with their Smith Maneuver. They know what they need to do. They're not worried about making mistakes anymore, and they can move forward powerfully with confidence. If any of the 5 accelerators will work for you now, or if you want to set up for them in the future, we can review that, talk about it, talk it through. Diversified portfolio management. So conveniently invest small or large sums of money once or on an ongoing basis. If we're real estate focused, there is still a place where we need to park money for a period of time. We can help you park those small amounts of money. We have ultra low minimums. Some accounts are as low as $1,000 before we'll invest the money, and some are around 5,000, but both very small minimums. And you can add to them. They're all completely digital solutions. You just click a few buttons, money goes in, You click a few buttons, money comes back out. We don't have any holding periods or anything like that. So if you need somebody to do the portfolio management, we can do it for you. If you want to do it yourself, it's fine with us. We'll work with you and you can invest all your own money or even ask us how to do it, and we can get you started on the right path. A brainstorming partner. I find that a lot of people who are interested in the Smith Maneuver typically found it from a mortgage broker or a friend or a webinar online that they watched. And those people watch other webinars. You know, I bet you a large majority of us have watched a webinar on the infinite banking concept, private lending, lending bond funds, mortgage investment corporations, syndicated mortgages, all of these items here, passive ETF investing, insured corporate bond strategies, how to do the corporate personal pension plan or enhanced Smith Maneuver. And what we provide is the ability to come to one place and talk about all of these areas. You know, I can deal with any of these in a financial plan. I can teach you about any of these areas, let you know if it's a good time to think about it, or what markers you need to mark off before you venture down one of these roads. How does a TFSA loan work? How does an RSP loan work? Why would I use one? We can talk about all those things. Passive ETF investing. So we can talk about why passive ETF investing gains so much momentum and so much popularity, the pros of it. And we can also talk about the cons of it, because passive ETF investing has not been popular for a long time, maybe 10 years, probably less than that. Wealthsimple started, I believe, as a corporation in 2014, and then came online for the public in 2016. And that's really the largest passive ETF investor in the market. So it hasn't been around very long, and there's pros and cons to both. Ongoing consultation for life events and new opportunities. You know, similar to what Chris was saying, when we build a financial plan, and I'm going to show you one live in a minute here, it has everything built in, and then we save a copy of that, a PDF, and we send it to you. So you have a sort of a mark in the road of what's going on, and we can continually update that plan as we go, and you can look at old plans and new plans. So anything new that might come along or new opportunities. Part of the process, or one of the first things that I would help somebody with if we were working together, and I suggest you do this yourself if you're not planning on working with a financial planner, maybe you're way down the track, but having a picture and a drawing of your financial situation and all the different buckets that you might have going on. So this is one of the first things I do. I draw out a Smith Maneuver for somebody. I use their numbers, so their mortgage payment, how much interest is not deductible currently, how much of that payment goes to principal, how much readvances on a monthly basis, moving that money to a Smith Maneuver checking or savings account, cannibalizing the interest, how much that's going to be on a monthly basis, and how much is left over, and where can we invest that? And I'll walk through that with you on your bank account, your mortgage structure, so that you feel super confident about where your money is transferring to and where it's going on a monthly basis. Just the plain Jane Smith Maneuver in this scenario converts a mortgage in 6 years sooner than regular, and you'd improve your net worth by $353,000. And this is fairly up-to-date interest rate. Pretty sure this slide is a couple of weeks old. So because I got to keep updating it now with all the interest rates going up and change all these numbers. But instead of paying off your mortgage in 30 years, this mortgage would be converted in 24 years, so to fully deductible. If you have an accelerator that we're going to use, I'm going to draw an accelerator out with you. And we're going to go through so that you feel confident in where your money's going, how much is going there, and you can track it in your accounts. If you have a sole proprietorship, a rental property, and that rental is bringing in $2,500 a month of rent, your mortgage is $1,800. We're going to add that rent to your regular mortgage payment. Prepay your mortgage down, $3,500 is going to readvance, come through the Smith Maneuver checking or savings account, cannibalize the interest. A portion will go to pay for mortgage and expenses. The remainder can go to a non-registered investment account. Just by having a rental property that's bringing in $2,500 worth of rent, we're going to convert this mortgage from 30 years. It's a 30-year mortgage. We're going to convert it 18 and a half years sooner than it would be regularly paid off, with almost $1 million in net worth improvement. And when you can draw this out, throw it into a financial plan, I mean, this is life-changing stuff. Absolutely incredible. It's a $700,000 mortgage I converted, this one here. So No matter what version of the Smith Maneuver you're doing, I recommend drawing it out. I'm currently in a Smith Maneuver. I've converted about $215,000 on my mortgage. And the amount of tax deduction that comes off of that every year is such a nice little bonus. And I feel like accountants get excited about that. They're like, wow, you got this awesome tax deduction. It's just like an additional tax deduction you don't normally get. And it's an exciting part of doing taxes. So now I'm going to flip over and we're going to do some real-time financial planning. So it's going to be interesting to see how this goes. So this is the financial planning software I currently use. It's financial planning software called NaviPlan. I would say it's one of the top financial planning softwares in the market. It recently got bought by InvestCloud, but so far they have not changed it, thankfully. So you'll see though, as far as from a client perspective goes, let's jump back here. So every time we do a plan, we can create a new engagement every time we meet. And so you can see that I have one back here from September 15th and one back here from May. So we may do a bunch of planning in the beginning, a whole bunch of different simple calculators and forecasters, and that engagement might be over. Then we move to another time and we can create some new plans. And so we always have a history of what's happened. So here's a new engagement with a new, I have a Smith Maneuver that I've already got started in here. And when we come in, this is what I'm talking about having a checklist to go through. So a whole bunch of different itemized things that we can start and work our way through so that we don't make any mistakes. So modules, we have assumptions. So we come in here and change everything we want. So we can have inflation changed. If you have account fees, if you're say using a discount broker and you have like a set fee, or you've hired an investment planner, that's fine with us. Just so you know, you can use somebody else, not a problem. And they might have an account management fee that they tack on to the MERs of their accounts. It's all in here though. So we have a very robust built plan, and we have real estate assets, what the growth rate is for those, how we want to split things, even Canada Child Benefits in here. So very robust. Milestones. So when we want to retire, historical data. So a lot of you might have historical things, alternative minimum tax carryover from your accountants, past RSP contribution room, RESP contribution room, capital loss carryovers. So we can bring everything forward. Coming into net worth. So what I'm hoping that this shows is like an actual example of what it would be like to work with someone who's doing financial planning for you, whether it's me or somebody else. But this is sort of that flow in that process. And I'm hoping that there's a benefit here that now you know what it would be like to hire somebody like this, and you can choose whether you want to or not.
So how would this work normally, Graham? You would set up a call with someone, you're going to maybe jump on Zoom, you're going to go through a series of questions while you understand their goals and their reasons and their why. You're going to start learning and filling out these details. Okay. And then how long would that usually take, as an example, for a regular person?
Yeah. So if you're what I would say, deemed simple in terms of not a lot of moving parts. So maybe you have one rental property, not incorporated, and T4 income, I would say we can get a plan like this in pretty good shape in 3 hours, 3 to 5 hours. We can get one of these pretty well handled, including some goals and conversations, getting to know each other. As soon as we got corporations, if you just have an operating company, we're probably 5 to 8 hours. And if you go OpCo and HoldCo, multiple properties, then sky's the limit. Let's go 10 plus hours. Yeah.
Okay. And what is the, like, professionally, what is the benefit of this? Like, we've talked a lot about understanding your goals and the vision, but can you show, like, what is the output from this?
Yeah. You want me to jump to there?
If that's not next, please ignore me.
It doesn't, I've already got a bunch of stuff built, so it's totally fine. So I'll go back and show how I built the pie, but this is the end. We get to a current plan. And so what I always will do is exactly what you have currently going on. No suggestions, no additional strategies. This is what you got going on. And so it's going to tell you a net worth synopsis. So at the end of this year, what your net worth will be, and then at the end of the plan. So whenever you die. And cash flow, it'll show a surplus or a deficit of cash flow for the end of the year. And then it'll show a retirement on track percentage. So in this example, they're 74% on track for retirement. And so we can go through and see, oh, when are we going to run out of money?
So this ties in really well for those clients I speak of that ultimately, if they do absolutely nothing, they'll reach all their goals. Why take on extra risk? So this will help screen that. I'm borderline. Should I start leveraging? Should I go buy this or that?
Absolutely, yeah. So you can see here in this current plan, we start running out of money. And now we're into a deficit.
Do you call a fortune teller to predict when the death is, or how do you figure that out?
Yeah, it's a big calculation that could take up to half an hour just to figure out when the death's going to happen. So yeah, we do all that. And so we'll come through. There's a few items I do want to cover here so people can see some of the benefits. Principal residence, you can have personal use property here, and then liabilities. And this is important, I think, for a lot of us, where we may have multiple mortgages, multiple properties, and keeping track of them all and how much each one is going to work out, or when the mortgage is going to be paid off, what the interest charges are. This keeps track of all that. So I can add investment property here, and it can be very granular, joint ownership or singular ownership. I have purchase dates, purchase amounts. I can depreciate properties, capital cost allowance rate, just like we were talking before, where, a lot of real estate, 4%. Current market values, start of the year market value, and then we can have rental information. I think this is one of the biggest benefits of NaviPlan financial planning software, is I can have a rental income of $2,500 a month, and I can have rental expense of $200 a month, and then I can inflate them separately. And so now my rental income, 3% of that will go up every month, and my rental expense, $200 will inflate by 3%. I can inflate them separately so that I can get a more accurate picture of rental income in retirement.
So this would be useful for, let's say, BC, where there's rent controls, where you expect the rent controls will be less than inflation. Okay. And can you adjust for, let's say, someone's 50% owner?
Absolutely. Yeah.
Okay. Yeah. So this might be really useful for any of you that are doing joint ventures. And
absolutely.
It's going to take a fair bit of time. You're probably going to want to map out the data, but Graham can actually help you work out your joint venture portfolio and account for everything. So the biggest mistake I see a lot of investors make is they just start running. They don't look and they don't stop.
Yeah.
And this lets you figure out, are you on track? Are you ahead? Are you behind?
We can also generate rental expense as a percentage. So you might say, well, it's just going to be 15% of whatever the rental is forever, and inflate those by 3%. We also might want to make sure we should sell this property or not. So, hey, we got a rental property and we're planning on selling it before we retire. What are the tax implications of that? So we can come in here and we can sell this rental property, and it'll show us exactly what the tax implications would be.
It's one of the most common things we come into for private lending, is people trying to sell properties or to pass properties off, even more commonly, to their kids. And all of a sudden, whoa, there's a $400,000 tax bill and there's no plan. So I love this.
So multiple properties can be in here. You can load in as many as you like, and then multiple liabilities. So in this scenario, I've got a mortgage, it's joint, it's variable, it's on the principal, it's a principal and interest payment. It's on the principal residence. I pay it monthly. The balance of date. So now I've got a variable payment down here, which is pretty interesting. I can go variable payment on 500,000, choose the amortization. It'll create the payment for me at a given interest rate. I can add an interest rate period. So some of you might be concerned right now. You might be saying, well, what if this lasts 5 years or 10 years? What if it goes up again? Then it comes down. Will I be able to make it through? We can add an interest period and change, say we can go for the next 60 months, it's going to be 6%, and then 4.55 for the remaining months. So we can get a very accurate, detailed, worst case scenario happening here. We can add debt modifications. So if you want to pay off your mortgage quicker, we can modify the debt right here and add more money to it, or vice versa. As I come down, now I'm on the line of credit. This one is showing fixed right now, but obviously it'd be variable. I'm just going back to fixed so I don't get errors. But I can add a debt modification in here where it increases by the amount that I'm converting on a monthly basis. So I know the exact size of my line of credit at retirement, basically taking a Smith Manoeuvre calculator, bring it into a financial plan. All account types are supported in here, pretty basic stuff, but RSPs, TFSAs, non-reg, anything you would want. We can link it to real world assets. So if you're really interested in getting detailed, we can come in here and do that. We can override interest rates, tell the computer whatever we want.
Now, Graham, someone's asking if you're building out a plan, would it fall into your role deciding joint ownership versus tenants in common on title, like kind of the tax planning aspect of ownership, and should you structure joint accounts, separate accounts with a spouse?
So I would say that in my wheelhouse, when it comes to account types, since I came from the publicly traded securities world originally, very comfortable with how we should structure these account types, spousals, whether this should be a joint, non-reg, or individual. When it comes to real estate ownership, I would defer that away. Yeah.
Whoever asked anonymously, but in my experience, the answers will typically come from, you'll get an answer from the financial planner, an answer from the accountant, an answer from the broker, and an answer from the lawyer. And it's a question of which combination covers off the best overall solution for you.
Yeah. So some of you might be interested in, holding escrow, something like that, and we can have that. It'll grab the real world return and pump it right in. So we can do that, no problem. Private corporations. I think this is pretty neat. So we've got an operating company. I can modify this operating company. I've got qualifying small business here. I've got share structure here. So I've got two different shareholders here, dollars per share with their shareholder total capital paid in. I've got historical data from the corp, investment accounts in the corp, real estate in the corp, liabilities in the corp. Again, all these can be drilled down and modified all the way through to withdrawals, sale information, even business activity. So if you want to include business income, business expense, and shareholder salary in here, all of this can be produced into spreadsheet. And you may find that working with me saves you a bunch of money with your accountant, because a lot of this is going to put you pumped right through to the accountant. And I think I'm cheaper than an accountant. If you have a holdco, we can do that as well. And we can transfer dividends in between companies. So that's all available in here. Cash flow, we can have simple cash flow where we just include salaries. But as you can see here, we have all different types: bonus, dividend, any type of income you want to have. If you'd like to do the expenses through here, we can do that. I typically just go, one big expense, and then that helps with some of the calculations. But if you want to get specific, you can. CVP and OAS included, defined benefit pensions, that's included. Let's move down to retirement planning. So all of your typical retirement planning, and just a little bit more detailed. So you want to retire at different ages, live different ages, and then calculating retirement expense. So everything can be produced as a percentage, or we can choose a specific amount. And in this case, I've said, okay, we want $12,500 a month. I want it inflated, and that's how much I want from 60 to 75 while I'm partying. Then I'm going to tone it down at 75 and live off 7,500 from 75 to 95.
And can you factor in things like you expect to contribute $50,000 to your kid's education, or to pay for a wedding, or help them with a down payment?
Absolutely. So we start at retirement, and then we can move to an education tab. So we have goal funding for education, goal funding for major purchase. So I want to buy an investment property. I want to pay for the wedding. Any goal you have, we'll break it down and have a plan for savings for each one. And then swinging back to this analyze goals. So this is the current plan that we have going on. You can see at plan N, there's 15 million in net worth. The recommended plan, so we can go in to that original plan and we can begin to modify things. So if I come into net worth, I come into real estate, And you can see here, I've added a personal loan now. So this is where we have a line of credit, the cost of that line of credit, and it's increasing on a monthly basis, facilitating a Smith maneuver. Under the strategies, I've got a saving strategy. So joint non-registered account, $1,700 a month is going in. And I have that increasing a little bit because of how the principal and interest payments work on a mortgage. That's happening. So we have that going on. And so all of these strategies can be placed on here. We're 91% of the way, we're 9% short of retirement. What are my options? What can I do to make it 100%? I want $12,000, $12,500 a month in retirement. What can I do?
Now, while this is loading, someone's asking, is this tool, the interface, only for you, or do you ever let the clients get behind the wheel as well?
So currently this is only for me, but I have there's a possibility that in the near future, we'll be able to turn this over and have some client work as well. So in this scenario, it says you're currently on track for $139,000 a year right now, not 12.5. So you could lower how much money you want to 139,000. You could save an additional $569 a month. You could save a lump sum 100,000, or you can retire a year later. So it produces 4 different options of how you could make it to 100%. And then every plan produces reports. So we have a ton of reports to choose from. I would say one of the neatest reports I think is cash flow and itemized cash flow projection. So for any of you with corporations, this will look very familiar to you. I'm going to grab 10 years, starting the year before retirement and then running through. And it's going to produce a financial statement for me for all of my income and expenses for all the data that I've put in. So here I am, last year of work, I make $394,000 based on inflation. I got half a year of work and now I'm fully retired in 2047. Where does my income come from? I get 30,000 from CPP. I liquidate my TFSAs first, and that gets me to 282. I've hit my goal. It's all I needed to do that year. Where's my expenses going? I've got a mortgage still, 30,000 a year, and my retirement expenses are 244,000. I'm still paying for some insurance policies here, and then I have to pay, well, in this case, no federal income tax because it's all TFSA income. So moving along though, my operating company is going to start paying out a dividend at age 70, CPP and OAS, and now I've got RSPs that have to be liquidated. And so now I'm up a little bit more, and now I've got federal income tax. Now I'm paying $80,000 to the government. So this immediately shows me how much I'm going to be paying in tax every year, when I'm going to be paying that. I can slide from this onto another 10 years and apply the settings immediately and just shift over 10. And so I can see how much money I have, how much I'm making, what's going on. So just a really useful report in my opinion. And this goes for all the reports. I can look at cash flow on a multi-year basis, retirement cash flow, surplus and deficits, estate planning, how much can I leave behind, insurance, should I buy a whole life participating insurance policy now? Do I have enough assets? Does that make sense? You know, I've got 300,000 of retained earnings in my corp. Maybe I start looking at an insurance policy I don't have to pay for, and I can get a loan for an instant financing arrangement. Maybe.
This is some Alice in Wonderland stuff.
Yeah, maybe. So, and we can, you know, that's just what comes up as we start to talk. This is the foundation, and then we get to a certain place wherever the client is at. I say, hey, it might be time for this. Let me explain how this strategy works. We talk through it for 45. You ask questions. You decide if you want to do it or not.
Now, let me ask you, just because you mentioned something and I'm curious, you mentioned liquidating the TFSA first, and that may not be something that people are familiar with. Is there a benefit to it, to pushing out the tax bill further and draining the tax-free savings first?
Yeah, so this plan that we're going through right now, it gets modified once in a while to show different things. So very rarely are we liquidating a TFSA first.
Okay, I was just curious if there were certain benefits.
Yeah, so the computer will figure out some things automatically, but almost always we're probably going to change some things as far as liquidation order goes. but we can change that in the computer. So we can change liquidation order. Um,
That's awesome. So let's say someone wanted to live off debt for a period of time, as we'll often see some wealthier people do. You can incorporate that as well.
Absolutely. Yeah. So we can have insurance strategies in here, and we can create a loan and live off debt for a while.
And the
And
reason
I
you
would
want to
say
do that,
spreading living off of the loan, spreading it over a period of years to reduce your tax bracket, smoothing, really, it can be a huge benefit.
you explained it. That's awesome.
Yeah.
It's just important to know, everyone, that you can get a lot of extra mileage out of your planning and the assets you have if you optimize them. Like, you see it more often than I do, Graham. How substantial of a difference does this make? Have you had clients that have thought they're going to have beans and ram in retirement, and you can kind of take it a step further by just lowering the tax burden? Or
I would say that one of the major differences between plans really is retirement income amount. It's such a, the magic of compound interest over the life of a retirement. People used to retire at 65 and die at 80, right? I mean, they had no time to spend their money. It was like 15 years and all gone, all good. Didn't need a lot. But now people retire at 60, or they retire at 55, work part-time, and they live all the way to 90. I mean, we have 40 years of income to look after in retirement. So it's not just 15 years, spend my RSPs and I'm done now. And so the amount of money you want per month spread over a long period of time makes a massive difference in a plan. If I drop this to like 11.5, it might hit 100% instantly. It's that easy. So I think that makes a difference on your current lifestyle. I also think that we shouldn't be sacrificing everything for today just to retire at 60 with $12,500 and have no lifestyle all the way there. Not interested in that personally. I'm interested in having a fantastic lifestyle now where I can be happy, not feel like I have to be scrimping and saving and in a non-positive way. So if I have a plan that shows that I can be on track and have discretional spending of $500 a month versus I would have, had discretional spending of $50 a month, well, that's great news for me. I
that
can
was
have a lot
something
of
I
fun.
struggled with a fair bit. Was I got sucked into the fire groups and got excited, and next thing you know, you've sacrificed all the quality of the life of your younger days because you're going to retire at 45, and then you realize why.
I have a fantastic passive income personally, and it's not like rich and wealthy. It's enough to have a great lifestyle where I live and not have to work 52 weeks a year. And I did that for 2 years. And then I was like, well, I'm done with that now. I think doing something you love is so much more important. Having a career you love, or, working on a business you love, or at least enjoy and becomes rewarding. I think that's important. So, and having, hobbies and lifestyle.
Even when a lot of people do napkin retirement planning, one of the things that I catch quite regularly when chatting with clients about it is that, oh, well, we only need $7,000 a month to live, let's say. Okay, great. Is that net?
Yeah.
And all of a sudden they're like, what? And you point out that, hey, that's $7,000 a month is going to take, let's say, 10 grand a year in income. And all of a sudden, all the calculations explode because they miss the 30% burden or whatever it is that taxes are going to be.
Yeah. I'd say, why wouldn't you have a financial plan? Even if it, actually, I had a great story about this. I was working with a couple who very well off, and they were just coming in for 1 hour planning session. And she came in and never met them before. And she goes, well, I'm an accountant. And I was like, oh, and I'm like, I wish I had known that before she came in. It's a different meeting when there's an accountant in the office. Anyways, I mean, she had mostly all of her own ideas. She's been reading, she's already retired. She's reading books every week on retirement planning. And, and so she said, I want to do this and this. And I think, she was just here to confirm that everything that she thought she was going to do was right. And then she didn't have to think about it anymore, and she could go and be retired, And so I think you could come across financial planning a lot of different angles. You know, why not confirm that you're right and then go on with confidence?
No, for sure. Someone's asked another question. Do we want to tackle it or do we want to save it for
Yeah.
the end?
No, go
Someone's
ahead.
asking, is the software able to account for passive income investing style, which is different in approach compared to regular stock investing, i.e. growth investing, and the math projections is different? So I guess, can you run different investment strategies? Like, let's say someone's investing into a dividend fund versus growth stocks. And
So I don't 100% know what you mean, but I could just go there
I'm reading
and
the question as is. I don't get it 100% either. Whoever asked that, do you want to try to word that slightly differently? I
like if
assume
you
essentially, can you just assume the money's invested in scenario A and scenario B? Maybe scenario A has taxed dividends on a regular basis starting earlier and a lower growth versus less income early and a higher growth, which I assume would be what they're getting at.
So under the holdings right here, so I can have interest, dividends, capital gains, deferred growth. I think this might be where you're getting at. So maybe you're saying, hey, can I have, you know, a 4% dividend rate and maybe 2% in capital gains for my total of 6%, but it's going to be taxed differently. Maybe that's what you mean.
I think that's probably what they're getting at. So I think the answer is that Graham's able to run.
I think so.
different
Yeah, if
investment
this is what you
strategies.
mean, we can do a pre-retirement and post, and depending on that. I mean, you can also just go and grab a holding. You know, like I was saying before, you can grab, you know, VBAL or whatever it is you want to invest in, and
So
it'll
you could
grab that.
literally plug a dividend paying ETF in here.
Exactly. Yeah.
Perfect.
But
some
so
people may be wondering why this matters, but as someone who regularly works with clients, that I've seen what happens when you kind of drift, and I really love this. It's super complex but relatively intuitive, and it looks like you can probably use this to plan out just about anything.
yeah. Let's see if I can find my slide deck. Here we go. So I thought I would show this too. I think it's important to be pretty transparent as far as fee structure goes. So whenever I meet somebody, we usually do a 15-minute chat to get to know each other, see if we'd be a good fit. And I think everyone should know what's available for me to get paid on or how I would charge. So I have a consulting fee schedule, and I find that this works for a lot of people. This is a by the hour fee structure. There's no minimum times per year, no maximum times per year. You choose. At the end of every meeting, I send you the documentation that we've worked on and wherever we got to. And if you want to hire me again, you hire me again. So it's very flexible, very convenient. So one-time sign-up fee of $499. And then I charge $300 per hour to anyone who comes in off of my website or off the street here. Anybody in the Smith Manoeuvre certified professional world that sends a referral my way, we discount the hourly rate. And we do that because that's the ongoing cost to somebody. So that's an ongoing discount. So the first meeting with me, if you're paying by the hour, is $700. And then every meeting after that is $200 per hour. And again, no minimums, whatever. So it's really straightforward. You just pay over PayPal with a credit card. You book every session's an hour and away we go.
Someone's going to ask, is this tax deductible?
You have to ask your accountant, but it is financial advice. So it's up to you. If it's a cost of you doing business, it's tax deductible. Assets under management. So some of you may be coming from a traditional fee structure where you're working with someone at a bank, you're working with an investment advisor, some other, investment sales professional, and you're already paying an MER on your products because you don't have time or you're not interested in managing them. We have ETF dividend paying portfolios, ETF capitally appreciating portfolios, US portfolios, whatever it is you want, we probably have it. And we have a fee structure that will probably beat that where you're coming from, especially in the sub 500, we crush that market. So any accounts under 100,000, I'm going to charge you 1% a year for financial planning. And then the product cost and the portfolio management fee is 0.5. So your total cost is going to be 1.5. I would say what's typical right now in the mutual fund market is somewhere around 2. some people are still holding out in greedy land at like 2.25 and 2.5, but the regular stuff is 2. As soon as you cross over 100,000, we go down to 0.8 plus the 0.5, so 1.3, 0.6, and then 0.4 on any accounts over $500,000. And those will be charged to your investment account on a monthly basis. Insurance commission. So I do have an insurance license, and if there's an insurance commission because we work together and eventually there comes a time where you want to purchase insurance and you buy it from me, I'm just going to tell you what my insurance commission is, and then you can have that many hours of consulting or whatever else we decide. One of the other benefits is I'm not attached to a mutual fund dealer, so I do not have a mutual fund license. So I can really choose however we want to structure our compensation agreements together. So I don't have a regulator who mandates what I have to do. If any time you have insurance over 100,000 of assets with us, then you never pay a consultation fee. So we waive that, and because we're going to make $800 or $1,000 a year from the assets under management, it's, on an ongoing basis. So we just waive those fees.
And one of the things I realized is about 5 years ago, I was about 3 years into working with real estate investors, and I got super into the stock market. I started reading company financials, and all of a sudden I look back and I realized I'm like, last 4 months, I've spent like 100 hours looking into how to optimize. At the time, I was in my early 20s. I had whatever I had saved up. And I started doing the math on all the time I was putting to learn and chase ends and checking Yahoo Finance every 8 times a day. And I realized, and I think this probably applies to a lot of us, often if we have our own careers, our own businesses, and we don't have $2 million investments, our best return on investment is getting someone professional to do this stuff for us, rather than putting all our time and energy into it. Because at least in my case, I realized I was making like $8 an hour looking at stuff. It was fun and it tied into my career, but then it kind of got stressful. And I realized that it's literally 10 o'clock at night and I'm checking what the market closed at. And I think it's really important to ask yourself, if you're going to try to do this yourself, what is the benefit? If you're younger and you've got 60 grand and you're building a new career and you're going to squeeze an extra 2% out of your portfolio, what does that really mean versus progressing your career faster, building a better business?
So that's all I got for tonight. I see there's a couple more questions. We can, if anybody has any questions or anything else they want me to expand on, I'm happy to expand on things.
Do you want to dive into the questions, Graham?
Yeah. I'm not sure if I open them, if everyone can see them, but maybe not.
No, I don't think only we can see them. So you're getting a little positive feedback. Someone saying you're speaking their language. They've never heard of any financial planners mentioning the kind of stuff you're talking about. So thumbs up.
Nice.
And someone's asking about the asset under management fees. Whose assets do you provide?
Great question. So I have multiple providers. I have 2 different robo advisors that I refer to. So one's called Modern Advisor. They're, you can use them without me. They're, totally separate entity. Modern Advisor is one. The other one is called Just Wealth. Modern Advisor is out of Vancouver. And Modern Advisor is great. They have super cheap ETF portfolios. And then they also have, actively managed stuff. If that's your slice of pie, they have that as well. So, and then Just Wealth is a pure ETF, passive investing, but they have many account types and lots of options. So I use those 2. BCV Investments, Vector Financial. I would say that would be the top there. Yeah.
Awesome. And someone's asking if you can just break down what the Smith Manoeuvre discount is again.
Sure. So I have the one-time. So for those people who are interested in a sort of an hourly rate, just working with me on an hourly basis, I have a one-time sign-up fee of $499. And then typically I charge $300 per hour. But the Smith discount lowers the hourly rate to $200 per hour. So the first meeting is the $499 plus the $200. I'm rounding up, it's $700. And then every meeting after that is $200.
Awesome. You're actually quite fair in your pricing. I've seen a few others present, and I've seen some that even they use a flat fee and they basically offer what you do and they say, oh, it's $5,000. And you do the math, they're not putting that many hours in because those are plans
Yeah.
for very basic situations.
5,000 is pretty common. 3 to 5 grand, pretty common, I'd say. And yeah, I mean, a $5,000 plan, you have to be pretty complicated for that to deal with that many hours.
No, it's one thing I've always appreciated about you with the clients who work together is that you've always been very geared towards what's best for the client and not how much can I charge on this one. And I really like how transparent all of your pricing is.
Does that mean every meeting is 1 hour long? So I haven't had a lot of requests for shorter meetings. I'm open to shorter meetings. I have one time this year where somebody actually bought 5 blocks of meetings. So they just bought like 5 hours right to start. And we didn't we would have like a 20-minute meeting and they would be like, okay, got to go do that research. I don't like use that as the whole hour. I just pick up where we left off. So I'm not sure if I want to get in the habit of people buying half an hour blocks all the time. But I'm more than happy to, if you buy an hour block and we don't use it, I don't mind meeting again for another, 20 minutes or half an hour. Doesn't bother me.
Now, Graham, someone's asking, and I assume they mean the setup time. If someone does the assets under management, do you still build out the same plan, and does the annual fee cover the time to build the plan?
Yeah.
Awesome.
Yeah. And in my in our original talk, the understanding is that investing the assets under management, we have no lock-in periods. So, you could put all the money in, get a whole plan in a month, and then take all your money and leave. You can do that. And, whatever, if that happens, then, good luck to you in the future. But our understanding is that you'll leave the money there for a year. But again, there's no contractual lock-ins or anything.
So it sounds like if someone's on kind of their integrity, willing to commit with you a year, you're actually willing to let them get involved for far cheaper than paying the hourly consulting, knowing that you've got the data behind the scenes. Clearly you wouldn't do it if it didn't work. You're good enough at what you do, and you do it comprehensively enough that most people stay. So
yeah, I learned everything I know from Robinson Smith. So
it's awesome. Some Robinson guy in here asking about the Smith Maneuver. Never heard of that one, buddy.
Could be a more advanced version of the, the Smith Maneuver.
Probably created by someone smarter than Robinson Smith. But I'm glad you're here, buddy. Someone is debating setting up a company to contract their services in their current job instead of being an employee. Should they run through scenarios to compare being an employee to incorporating and doing that same role?
Absolutely. That sounds awesome to me. I mean, 9 times out of 10, you make more money as a contractor and you work less hours. So you get better lifestyle, in my opinion. Plus you get to control the income. Most of the time that's going to work out, but yeah, that's something I get jacked up to talk about for sure.
We see it a lot in our industry as well. Like as a broker, I'm incorporated, and there's definitely benefit. And I think most of us will find that when you get really, really good at something, when you get good enough, you're going to go and start your own business and do it. You tend to get very efficient at it. And the nice thing about it being contractor is often you'll spend 25% of the time to do something that most employees would. And we'll often see a lot of our clients that go contracting, they can scale their business significantly compared to what they can do as an employee. But your financing gets reset and you need 2 years financials the moment you go self-employed. So it's really important that you plan out your financing before you take that leap. Otherwise, you're in no man's land for a couple of years. And that's when brokers get excited about B lenders and private.
Yeah, 5 to 10 hours to set up. That's covered in the front end setup fee. So the one-time sign-up fee, there's a lot of work and research and behind the scenes things we do to get set up for creating a financial plan in the Smith Maneuver. And instead of having a higher hourly rate, so originally when we started this, we were going to have a lot higher hourly rate at like $350 or $450, but that kind of hurts somebody long term working with us. I found that people would book a meeting maybe 2, and then they would never book another meeting because they didn't want to pay $450 for an hour. So we front end loaded it with the $4.99 sign up fee, and then you pay $200 per hour per meeting. So if it takes us 5 hours to create a plan, then you're $700 for that first hour, and then $800 for the other 4 hours. So that would be your total cost. So there's no way currently of getting out of paying the hourly rate unless you're an assets under management client or you have an insurance policy to buy. And I'll tell you how much commission I make, and you can have that many hours in consulting based on that commission. So complicated plans can take up to 10 hours, and so you'd be paying the full shot on that. Yeah.
If someone's mentioned that they are cash damming, and with interest rates rising, they're cash flow negative, and they're wondering if it still makes sense to continue doing what they're doing. So I'll add quickly with the Smith Maneuver, if you're starting to get into a position where you're not stable and you're worried your situation is not sustainable, you need to go get professional guidance real fast. If you're increasing your monthly costs by implementing the strategy, which does happen to some of the accelerators, your net worth in 30 years is not as important as your stability over the next 12, 24, 36 months. So if you're starting to feel the situation get out of control because, let's say, rates are rising, you need to dial it back immediately and get some help. And
we did that earlier this year with somebody, no problem. That's one of the best parts with the Smith Maneuver. Super easy to unwind. So we sold assets, paid off the debt because and this client had 3 condos, 3 pre-built condos that they were carrying as well in a prime the pump, right? So this wasn't because of liquid privately traded securities that was causing the problem necessarily. It's because they had pre-builts where couldn't collect the interest deduction until those are built in the future, but they've spent the money today, and it was costing them almost $500 a month in interest costs just to carry those 3 pre-builts. And then they did a prime the pump into publicly traded securities on top of that. So thankfully, they're able to liquidate that and pay off that portion of the loan. Couldn't do it for the pre-builts, but real estate, a little bit more risk for a little bit more reward potentially. So yeah, it's definitely a conversation to have and to decide together, what's the impacts? How negative is this? If I get out now, you can always start again in a year or 2, Once you have a plan set up with a client, typically how frequently is it necessary to review? If you have a lot of moving parts, if you find yourself, you're in acquisition mode right now, maybe you have maybe you held out, you have a lot of cash currently, and you're, maybe you're into syndicated mortgages or what have you. We may meet once a month. We might. I have clients right now I meet once a month because they're just doing stuff. They're movers and shakers. They've got, hey, we saw this new idea. What do you think about this, Graham? They'll bring it to the meeting. We'll review it together and we'll make a decision whether we think it's a good idea or not. I would say if you're fairly straightforward, T4 employee, 1 rental property, running a Smith Maneuver once a year. Yeah. You mentioned your life license. Do you ever recommend seg funds for clients? If somebody is very conservative in nature, needs to create a pension plan for themselves, I might recommend a seg fund. If there's a specific estate plan in need, I might recommend a seg fund. Otherwise, there's very few reasons to use a seg fund. There's only a couple specific reasons, but the increased fees on a seg fund.
To explain seg funds versus mutual funds for people who don't know.
A segregate, it's the real name is segregated fund. To make it simple, and nobody run this by somebody like a regulator, but it's basically a mutual fund. Then they put an insurance wrapper on it where they typically guarantee a market value. So you might say you buy $100,000 into the Desjardins balanced fund, and they're going to guarantee that upon maturity, which might be age 90, or age 100, or when you die, that you're going to have 75% of the market value that resets, or the amount of money that you put in. Let's keep it simple. So they're guaranteeing you'll have $75,000 there one day. Most of us who are investing know that 10 or 20 years from now, we're probably not going to need a guarantee of 75% of a market value. probably. There's other seg funds that have 100% guarantee, but the fees are astronomical. We're talking 3.75, 4% fees.
Now, are seg funds creditor protected?
They are.
Oh, so that would definitely be one.
But there's, it's only a few areas where that, TFSAs are credit protected, RSPs are credit protected. There's a few areas for them, sure, but yeah.
I love to see you get excited about not being encouraged about something that pays you remarkably well. It's rare. Usually
massive
the
commissions and seg
licenses
funds.
are like, yes, seg funds.
Yes. Haven't get in touch with you, or do we need to be referred by Keaton to you? I think there'll probably be a link, Keaton, to me.
Yeah, I'm going to email everyone's contact details at the very end of all of this. So, but Richard, I'll send you Graham's details right away.
A great question about every time you have a question, do you have to book a consult? So this is like the pro and the con of creating a financial planning system where we charge by the hour, because we all want the charge by the hour because, we want to do our own investing, or we're real estate investors. So then I got to create a by the hour one, but then what if I just have small questions, and what if every question of yours is small and there's 12 of them and it's once a month and what have you? So my current answer, unfortunately, is if you're a consulting fee client, you must book a consultation in order to ask a question. It's the only way I can really keep the system running without people just sending me emails all the time and me answering emails for free all day long. That being said, if you're an existing consulting client, you've been using my services over a period of time, I'm also not going to get weird about it. So, yeah.
Now, what if someone wants to put a portion of their funds under your management, under, let's say, assets under management? Will you advise on the entirety of the funds? And because I know that's a gray area, and I know my investor clients and a lot of people, that question's going to come up.
So I am not a certified investment manager. I'm not a portfolio manager. So I actually won't give you any advice on whether I think you should purchase an investment or not. So specific investment or security purchase is not part of what I do. You would need a portfolio manager or a certified investment manager to do that for you. And that's why those people charge what they charge, because they have that role. I will tell you though, if I think you're out of line in your risk profile, or I will look at your investments for you and I will be like, hey, maybe you should look at that one. Not sure about that. Not specific stocks, but from a risk or from what type of accounts. And yeah, I really don't care if you have all of your assets with me or not. Not a problem. All the time. Does that mean we need to review the plan with you after every increase, or do you have a conservative approach assuming the highest worst case interest? So I'm on a variable mortgage with our lovely government, raising rates all the time. Does that mean we need to review the plan with you after every increase, or do you have a conservative approach assuming a higher worst case interest rate? I would say that working together, we're going to discuss interest rate increases, and that is going to be one small part of your plan. Sure, a big impact, but one lever in your plan. And so when that interest rate changes, the whole plan may not change. And in a lot of cases, we'll have already talked about, rates going up and then rates going up again. We'll probably have already talked about that in your previous meeting. So you don't have to meet with me every time a rate goes up, because the main change is going to be the payment on your line of credit. And my experience is that you will understand your own finances much better, so that you will know what you need to do when that happens. In case of a couple, are those fees 2 times? Good question. I should say yes, but I'm not sure. I do have 2 families I'm working with currently. And I'm just charging them for the hour because it's just my time. So I never see all 4 of them at once. Therefore, they spend a lot more time with me. So I think if it was a couple, I'm 100% in for that. Yeah. I would just charge you for the time you're meeting with me. Had to step away from the webinar, so not sure if you answered this question. Graham, are you a fiduciary? Great question. This gets asked a lot in my industry. So no financial planners are fiduciaries in Canada. Does not exist. The only people who are fiduciaries in Canada are portfolio managers. They're the only fiduciary in Canada. Fiduciary is a thing in the United States below us, where an investment advisor either is or is not a fiduciary. And really it's a piece of paper where they promise to do what's best for you. That's what a fiduciary means. Actually, I think also a notary is a fiduciary in Canada, actually too. Now I think
As
about
brokers, we're fiduciary. There's a bunch of industries.
there you go, right? So yeah, but financial planners are not fiduciaries. Neither are life insurance advisors. Neither are mutual fund advisors. Yeah, it's like not a thing I could sign up for. I'd have to be a financial plan, portfolio manager.
Awesome. Oh, we got another one came in.
So if someone transfers 100,000 or more, you charge the 0.5 annual fee. What products are eligible for that asset under management to be invested in, since you're not mutual fund licensed? So if someone transfers 100,000, then we're going to charge 0.8 or 0.6 or 0.4, depending on this here. And the products that are eligible, we have ETF portfolios. So they're managed by a portfolio manager, and that's why we have this product MER and portfolio management fee here. So that's 0.5. And then I'm going to charge this percentage in the middle. So between 1 and 0.4 for the financial planning advice. So this is the advice fee, and this is the portfolio management fee. And my fee is collected by the robo advisors or the portfolio managers, whichever term you want to call, and paid to me monthly. So yeah, dividend paying ETF portfolios, and then both active and passive ETF portfolios. The active portfolios have lots of stuff in them, and you would not be charged if you wanted to meet with me and learn about those investments. There wouldn't be a charge for that. Like, that would totally be okay. Do you perform your service strictly independently, or are you able to coordinate with other service professionals helping the same client for a more integrated approach when it makes sense to do so, i.e. accountant or Keaton? Yeah, I talk with accountants regularly. I will send your financial plan to you so you can send it to the accountant. No problem talking to accountants. Yeah, or Keaton. I can talk to Keaton or anybody in your circle. Yeah, no problem.
In my experience, the less you run around trying to say what the other professional said to the new professional, whatever they may be, the more successful things will be. It's often a lot easier and more efficient on our end too, to have your permission and, let's say, email, correspond, a very articulate question from one professional to another that we've already 80% towards the answer, and then just confirm or CC'd off we go, rather than you trying to spend 20 minutes remembering what the broker or the accountant said.
I used to be mutual fund licensed from 2009 to 2016. I was mutual fund licensed, or excuse me, 2016. And in 2015, my wife started a business. She's a 50% shareholder of our corp, and she started a business selling video courses on budgeting, how to grocery shop properly, how to set up your bank accounts, bank account architecture, and things like this of this matter. And the mutual fund regulators wouldn't let my partner sell video courses because they don't regulate that. They don't regulate how to budget. They don't regulate how to grocery shop. They don't regulate how to set up your bank accounts properly. And we would have to send, if we wanted them to regulate it, all of our videos to them to be put through compliance and then spit out the other end. And I thought to myself that year, I said, you know, who are these regulators that are telling me what to do? And all of a sudden, because they can't make any money from it, let's be honest, follow the money, they aren't willing to regulate it because we don't share any of our sales of video sales with them. And so that was really the beginning of the end of my relationship with the Mutual Fund Dealers Association, the MFDA, because I just kind of got that, you know, yeah.
It's pretty crazy how restrictive it is. I started to look into it when I started my LOQP and to my life insurance license. And you can barely put a Facebook post up without running it by them.
Absolutely. Yeah. So that was the end of that. So anyway, looks like the question has slowed down or maybe come to a stop.
I appreciate
It is being recorded. Somebody asked earlier.
it. So I'll be uploading the recording and probably then hopefully tomorrow, worst case Wednesday. So depending on how this cold goes. But I want to thank everybody for coming out. And Graham, do you have anything you want to add or?
I just want to reiterate how thankful I am for you running this webinar series. It's been fantastic. And to the whole, to Robinson, Robinson's been a huge help to me the last couple of years. So I want to thank Robinson too. And all of the Smith Manoeuvre professionals that we work with. It's been a great experience and just really thankful for this stage of my career to be kind of launching into this area. So psyched.
Awesome.
Yeah.
I do appreciate it. It's always fun to work with you too. It's nice to work with people who are clearly passionate about what they do. And I willing to bet that you're probably thinking about work and different ways to do things when you're not working, which I think is always a test of are you passionate about what you do in the industry. So one last
I'm
question.
located in Victoria. Yeah. Located in Victoria. And I hold licenses for insurance here, Alberta and Ontario. I can do financial planning all across Canada, including the territories. We actually have some products available to the territories as well, which is kind of neat. And any of our referral partners for ETFs are all the way across Canada, except for Quebec, excluding Quebec.
There's always the star Quebec next to it.
Yeah, I wish. Maybe one day.
Oh, we got straggling questions. Someone's asking, can you account for international investments?
So great question. I currently do not have any clients with international investments that I deal with. So I have no previous experience. If you wanted to meet with me and ask about it and see how I could model it, I'd be happy to do that and I wouldn't charge you for it. Yeah. I do have clients who are expats, so who used to be here, currently have real estate assets in Canada and live outside of the country and are currently non-residents. So while I'm not an expert in that, I do have experience.
Awesome. I want to thank everybody for coming out, and I will see you all at the next one. Thanks again, Graham.
Yep, you're welcome.
Cheers.